The stock market is one of the biggest wealth creation machines that we have ever made, making sure that you're investing on it on a consistent basis. In the last video, we covered both the dollar cost averaging and just the lump sum investing to put all of the money in there. Today, we're going to show you exactly why I invest in the S&P 500, mainly the VOO. Now, when it comes to index funds, they have an incredibly low rate, guys, in comparison to money markets, in comparison to individual funds. A lot of them do have a higher cost associated with it, but index funds made it incredibly easy to not only diversify your portfolio, but also made it very, very cheap to do this. Now, in today's video, we're going to be looking at the last 15 years of the stock market. Now, I know they say, that previous performance or past performance is not an indicator of future performance, but looking at the past 15, it is also kind of the benchmark or the threshold, kind of the run rate that I do look. When you look at the evaluation of individual stocks, when you look at funds, when you look at ETFs, it is always kind of looking in the past. Now, again, might not show you what future performance is going to look, but you can kind of get an insight and kind of get an idea of where we're looking. So thinking 15 years ago, guys, going back to 2009, that is right. That is already 15 years for you if you're doing the math. We are coming off of the greatest recession that we have ever seen. 2007, 2008, the S&P 500 was down 57%. That means, guys, if you're going into 2009, you are buying the S&P 500 at 57% off. So literally, and again, I kind of relate this to the shopping experience. If you see something that you're really interested in, like investment, which you should do over a long amount of time, 57% off is huge, guys. Now, I know a lot of people emotionally pulled all of their money out. 2007, 2008 market starts going down. The end or the very, very early months of 2009, we actually seen the bottom of the market. But again, pretty much impossible to time that. But then from there, what did we see in 2009? That's right, guys, a 26% increase. So going off of a 57% decrease to a 26% increase was crazy. Followed by 2010 at 15%, 2011 at 2%, 12 was at 16%, 2013, guys, was at 32% return for the S&P 500. Now, this, of course, does include the dividends. When they are compounded in there, makes a big, big difference. But a 32% return, guys, which again was a monster in 2013. Looking at 14, 13% right there. 15 was only 1%, but that's okay. That's a good buying opportunity for that year. 2016, 11%, 2017, 22%, 2018, down 4%. Now, looking at, again, the past almost 10 years, at this point, getting into 2018, we've seen a minus 4% for the S&P 500, which means we just had 10 years, almost 10 years, guys, of very, very solid growth. Then, of course, we kick it into 2019, 31% again was the S&P 500 growth, 31%. 2020, we hit 18%. 2021, we're at 28%. Then, of course, we see the effects of inflation, which, of course, is 22. Now, 22 ended the S&P 500 at negative 18%. And then, of course, 23, we ended at 26%. So we have had 3 years, guys, or actually 4 years that are 26% or higher within the S&P 500 in the last 15 years. Now, on top of that, we know the pandemic had a big influence. Inflation had a big influence on there. But if you would have been investing through that entire time, if you would have went in there and just lump sum invested, put it all in there. But if you went in there through dollar cost average, you could even see higher returns in here. But overall, guys, in the last 15 years, the S&P 500 has grown 13.8% on average. That is right, guys. That is the growth rate. Now, when you take inflation, so you actually minus out the inflation, the index grew for the last 15 years, 11.2%. So again, thinking big picture, guys, if I took a lump sum investment or dollar cost averaging, I put it into the VOO or the S&P 500, I would have gotten an 11.2% return on my money in the last 15 years, which is absolutely incredible when you think of how crazy it has been. Now, when you do include 2008, which we know was the housing market collapse, you would still be at about 6.5 to 7% based on inflation. And that is kind of the difference of what a year can make. So again, 2009, you're looking at 11% with inflation. If you include 2008, you're looking at 6%. That is literally just 1 year in there. So what do we expect for 2024? And again, this is a big part that I want to get into, guys. As we continue our portfolio with our dollar cost averaging, we are putting $1,000 in every single week. Now, we do get those from a multitude of places, including YouTube with our side hustle on our gaming channel. This channel is almost monetized as well. So guys, definitely subscribe to the channel. We have a lot more content with the daily videos that we're putting out. We cover budgeting, we cover finances, we cover the debt-free journey, the minimalist, really a lot of frugal savings out there, and the way that money should be managed. And in my opinion, the way that financial literacy should be taught. Now, looking into 2024, they are expecting a very, very well-poised position with soaring stock prices in 24. Now, I do take this kind of with a grain of salt, but I do look at a multitude of sources. When you look at publications, if you look at, economists, if you look at kind of everything with the strength of the economy and what we're seeing going on, usually it's kind of crazy that once we have a war like we're seeing right now overseas, there is usually a very, very strong correlation to stock prices soaring. Also, when you think of the Federal Reserve, guys, they have said we've kind of peaked on our inflation meter, meaning that 2024, 25, 26, we could actually see years where we're going to start lowering the Fed's fund rate, which of course is going to give the ability for some of these larger companies in the S&P 500 to start building and start buying money again, or start having money again, because it's not eaten up all by inflation. Now, this, of course, is going to make a huge difference, guys, because 2024 here is an election year. So, of course, that is going to throw another thing in the mix. If we have inflation kind of leveling off, if we have the prices start declining, which they are, if we have interest rates start declining, which they are, this again is really poised for a very, very strong 2024, in my opinion. Going into 25, going into 26, I feel like the next couple of years we are really set up for a lot of growth, especially with kind of the cryptocurrency coming online. I did put some into that Grayscale Bitcoin ETF that they have going on. Now, of course, cryptocurrency, guys, we know there are a few countries that have actually adopted it, that utilize it, that also take it as a form of payment. Very cool to see the adoption. And this really, going into the Bitcoin ETF, in my opinion, really gives a lot of legitimacy to, Bitcoin being kind of correlated to gold. And I know that's been drawn a lot of different ways in a lot of different times. That seeing as an asset that doesn't have an unlimited cap, it can be something that, again, a lot of people are going to use this transaction, but it's also opening it up to a lot of investors like you and me that is going to have the possibility to actually get a little bit of exposure to cryptocurrencies. And with that exposure, we actually do not have to buy Bitcoin, which means you don't need hardware wallets. You don't need, cold storage. You don't need wallets. You don't need an exchange. You can go ahead and you're going to be able to buy those through your regular investing like I do at M1. Link is right down below, guys. I love M1 Finance. I have used all of them. When it comes to investing, using, Coinbase, using Crypto.com, using Webull, using Robinhood, using M1, I have really liked the platform for M1, and a lot of people that I've actually brought over to the M1 platform have said the exact same thing, guys, that they are very impressed with the build and how M1 is handled. They also do have an amazing rewards card. So guys, that's going to do it for today's video. Again, last 15 years of the stock market has been a great ride. If you're investing that whole entire time, guys, you would see about a 7 to an 11% increase, depending how much you're putting in there, which means if we continue to see that, and if we have down years, this is the big thing, guys, is if we do have down years where we're down 4%, 10%, 12%, whatever it is, you're buying the stock market and you're buying stocks, you're buying those ETFs at a discount, which means you're getting more of your asset for a cheaper price, which I absolutely love. Anytime the market is down, I definitely buy. But again, through the dollar cost averaging, I buy every single week. On Monday morning, we put 1,000 in there until we hit that 100,000 mark, and then we'll see exactly where we go from there. So again, guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.